Hello, everybody. Kyle Davis here, Integrity Financial Group. Thank you for joining us here for our weekly Monday morning chat. Appreciate having you. Hope you had a wonderful weekend. I was having a chat with a friend slash service provider. He does some work for me here at the office, and we were talking about taxes. And he asked a great question. What are some tax lowering strategies in retirement? How can I make sure I'm not paying a boatload of tax on everything when I'm on a fixed income or drawing from this or retiring? I said, wow, that's a really solid question. Let's talk about that. Now, there are a boatload of ways to lower your tax liability in retirement. I mean, we could write a whole book on that. We could write a whole guide or build a whole website dedicated to tax lowering strategies in retirement. I'm going to focus on one particular way today, and it's a specific type of account, and I'm sure a lot of you have heard of this account before, but I'm going to throw out some things you maybe didn't know about Roth IRAs. We're going to talk about Roth IRAs today. It is probably, in my opinion, the Roth IRA is one of the most accessible ways to invest for retirement and do so on a more tax-free basis. Now, the fundamentals of a Roth IRA, you probably know some of this already. Let's consult with our buddies at the IRS. We cannot deduct contributions to Roth IRAs, but if we satisfy the requirements, qualified distributions out of Roth IRAs, keyword qualified distributions, are tax-free. Now, we can make contributions to a Roth IRA even after we're 70 and a half, which is a key retirement age. We can leave amounts as long as we live, and there's some other considerations as well. Now, that qualified distribution in a Roth IRA, what does that mean? A qualified distribution is a distribution or payment from a Roth IRA that is made after the 5-year period beginning with the first taxable year for which you first made the contribution for the Roth, and the distribution is made on or after the day you reach 59 and a half, made because you are disabled. That's an exception. That's a whole another can of worms. Made to a beneficiary or to your estate, or if you meet the requirements under a first home exception. That's a separate deal altogether. I believe it's up to $10,000. With that first home exception. You read a bit about that. Now, I will tell you straight up, before you make any decisions or before you go putting money into an IRA, it's very, very important that you understand the limits. There are some income limits. For example, if you're single or head of household, you have to make $124,000 or less to do the full contribution. And there are phase-out limits up to a certain point, after which you're not eligible at all to make a Roth contribution. And for couples married filing jointly, consult my little fact sheet here, that's $196,000 or less, couple married filing jointly, to be able to have both spouses contribute to the Roth. There are phase-out limits as well, up to a certain point that you're not allowed to contribute. Also, very, very important to understand that. I try to encourage everybody, really make sure you're going to be okay on that contribution, because if you're not, you get audited, or if that comes back to you, you don't want to get into trouble with the IRS. You just don't. Make sure you understand the game going in. I really want to harp on that, the whole Roth IRA contribution, though, because I think Americans are conditioned, at least to a point, that as long as I'm making contributions to IRAs and Roth IRAs, or I'm putting money in my retirement plan at work and I'm getting the matches, as long as I'm doing those things, I'm going to be okay in retirement. And I genuinely hope that is the case for most people, that's enough. But I'm such a numbers guy, and I understand the ramifications and the real due diligence that needs to happen to make sure that you're going to be okay in retirement. There's so much more to it to consider than just, as long as I'm putting money in my retirement plan, I'm going to be okay. And that goes back to the real reason we plan for retirement and do financial planning and such to begin with. We generally do this type of work. People go about financial planning and retirement planning usually because they care about somebody or care about the well-being of someone else, themselves and others. Because I'm always under the philosophy you can't pour into someone else if your cup is empty. Fair? I think that's a fair statement. I think we do these types of things, financial planning, retirement planning, really because we care. I realized years ago this business, this industry that we're in, this whole financial services thing, it's not always about the money. A lot of times it's about love and about the fact that we care for someone else. But back on track, to help with taxes in retirement, look into a Roth IRA. It is a very easy to understand, very accessible tax lowering strategy. And I've gotten the question in the past, well, what kind of rate of return does a Roth IRA use? Consult the video last week about financial planning or investing being a coffee shop, and an IRA is your coffee cup. That'll be a great primer to understanding returns inside of things like IRAs and whatnot. Also, side note, a lot of 401ks these days allow Roth contributions, something else to consider. I hope that was helpful. Have a great rest of your week, everyone. Next week, we're going to talk about FRS, the Florida Retirement System, and a couple of key considerations there. But for now, have a great rest of the week. This is Kyle Davis, Integrity Financial Group, signing off. We're your retirement planning specialists. If you need any personalized or one-on-one attention, you can reach us at financialservicesamerica.com or just give us a call. Have a great rest of your week. Again, stay safe, stay healthy, and we'll see you next time.